In this session, we are going to discuss the off-balance sheet activities of banks. We have two goals. First, I want to introduce the concept of a contingent asset and a contingent liability. These are items that do not show up in the balance sheets that we have seen so far. These items do not show up in the banking book or the trading portfolio of a modern bank. However, under current accounting standards, banks must record this information in their financial statements. This ensures that investors and regulators are well informed. Second, I want to describe the most important off-balance sheet or OBS activities at banks. I want to give you a sense of the size and the scale of this stuff. Okay, let's get right to it. To generate fee-based income, banks engage in a broad array of activities off the balance sheet. Some of these activities resemble traditional bank lending. Other items look more like insurance. What's important to remember is that off-balance sheet activities are contingent in nature. This means that when an event occurs, the off-balance sheet item has a material impact on the bank's balance sheet or cash flows. An off-balance sheet asset moves onto the asset side of the balance sheet or affects the bank's income when a pre-specified event occurs. The simplest example to think of here is a credit card. We are all familiar with credit cards. They have credit limits that tell us the maximum amount we can use. A bank has provided a commitment to lend as much as that limit. Banks record undrawn credit card commitments as off-balance sheet assets. When I charge my credit card, this is the contingent event, me charging the card, the bank will convert an off-balance sheet asset into an on-balance sheet asset, a consumer loan. In the same way, off-balance sheet liabilities will show up on the liability side of the balance sheet or affect the bank's expenses when an event occurs. These items haven't shown up on the balance sheet yet, but they might in the future. Guarantees, which act as a form of insurance, are common here. The bank writes the insurance today and records it off the balance sheet. If there is an insurance claim tomorrow because the pre-specified event happens, then this is going to have a material impact on the bank's cash flows. There will be a payout. Why do banks like issuing credit cards and writing insurance? Well, because it generates upfront fees. Here is the balance sheet. We have discussed the bank book and the trading book previously. And now here is the off-balance sheet. The most important items on the asset side are undrawn loan commitments and long derivatives positions. Credit cards can be charged in the future, and this will create loans in the banking book. Long derivatives positions can make profits or losses in the future. What about contingent liabilities? Here we also have derivatives, but now these are considered short positions that can also make profits or losses. And we have our guarantees. These guarantees can take a variety of forms, but they mostly behave like insurance. Under some conditions, the bank will have to make an insurance payout. Here is the data on the key off-balance sheet activities for all commercial banks in the United States. We have 1992, which is ancient history, and then we have the 2018 data. This information is collected by government agencies that want to make sure that banks aren't taking too many risks in these business lines. We are going to pay special attention to the unused loan commitments and derivatives. These are by far the most important activities. Let's start with loan commitments. A loan commitment is a legally binding promise to provide funds up to a certain maximum limit and at a pre-specified interest rate. These promises can be made to households or businesses. They can be unsecured credit cards or lines of credit secured by houses. Banks must stand by and be ready to provide funds at any time within the commitment period. And when that card is charged, a loan will arrive in the bank's balance sheet. This chart is from the FDIC. It shows the utilization rates of the various types of loan commitments in recent years. Home equity lines, business lines, credit cards. Less than 100% means that there is some undrawn amount sitting off the balance sheet somewhere. Let's zoom in on the credit cards. Here we can see some dollar amounts for both the drawn and undrawn credit cards. At no point in time did the drawn balances exceed $1 trillion. However, we can see that 4 to 5 times that amount is undrawn. Banks can earn fees on these undrawn balances. Regulators require that banks disclose these undrawn balances in their financial statements. Why? Because excessive drawdowns can create risks at banks. Now let's talk about derivatives. Banks can use derivatives to reduce their own risk exposure to, say, unfavorable changes in interest rates. Banks can also act as dealers and take the other side of a derivatives trade with a customer for a fee. In either case, the derivatives that are bought and sold may lead to some cash inflow or cash outflow in the future. The bank therefore must record these transactions off the balance sheet. The reporting here is done in notional amounts. So for interest rate derivatives, which is by far the biggest item, this is a jaw-dropping number, $150 trillion. If we think of derivatives as providing insurance, that's how I like to think of it, then this tells us about the total value of items being insured. However, this large number doesn't tell us much about the potential cash flow exposure that the bank has or the market value of these positions. For example, I might have $1 million of home insurance. This is the notional amount. But the insurance cost me $2,000. That's the market value of the insurance contract. While notional amounts don't mean much, the growth rates are actually meaningful. Loan commitments have grown more or less in line with the bank balance sheet in the past 30 years, about a 5x increase. Derivatives have shown explosive growth during this time period. Growth has been by a factor of 20. Much of this derivatives activity is actually concentrated among the largest financial institutions. JP Morgan Chase, Citibank, Bank of America, Goldman Sachs, Morgan Stanley, Wells Fargo, HSBC. These are the largest dealer banks. And having all of this activity concentrated in a handful of institutions reflects economies of scale in this business. Let me illustrate this point with JP Morgan Chase. Here is JP Morgan's derivatives exposure in 2020. Interest rate derivatives, credit derivatives, FX, equity, and commodity contracts. This activity is shown in notional amounts, as we have seen so far. What has been missing from our discussion is that a mega bank like JP Morgan is taking positions in thousands of derivatives transactions. Most of this activity is on behalf of customers. Here, if you look at the interest rate options, you can see JP Morgan is both purchasing and selling or writing options at the same time. This may naturally lead to some cancelling out or netting of exposures. Larger banks with more and more transactions may naturally see more netting. You can see this quite clearly with JP Morgan's credit default swaps book. You can think of a credit default swap, or CDS, as an insurance contract on a bond or a loan. If the credit defaults, that's our contingency, then the insurance pays out. What do the numbers show us? Well, JP Morgan is involved in about $1 trillion worth of CDS, mind-boggling sums. However, this is spread out equally between insurance sold and insurance bought. Overall, the net exposure is much smaller. This is how netting works. Hopefully, JP Morgan pays a lot less for the insurance that it buys than the fees it collects from selling insurance. Then this activity will make a nice profit without creating too much risk exposure for the bank. The off-balance sheet contains a list of contingent exposures. They have potential to impact the bank's cash flows at some point in the future. We saw that loan commitments and derivatives are the most important off-balance sheet activities. They generate the most fee income for the bank. We have said nothing about risk in this session. Risks that were buried off the balance sheet were at the heart of the 2008 financial crisis. These poorly understood risks led to the failure, distressed acquisition, or bailout of some of the largest financial institutions in the world. This led to a barrage of new regulations. A very interesting topic for another time.